Well, welcome and greetings, everybody. My name is Brian Davis with Accuplan Benefit Services and Retirement Checkbook. Today, I'm proud to have Brock Vandenberg of Talimar Financial on the call with us today. Brock, say hello if you're on.
Absolutely, Brian. Thank you for co-hosting this event. It's always a pleasure hosting these events with you. Thank you.
Yeah, thank you. Today, we're going to be talking about investing in trust deeds with your IRA or 401k. I will start the presentation going into the basics of self-directed IRAs, solo 401ks, and checkbook IRAs, and then we'll turn it over to Brock Vandenberg, who'll go into all the intricacies with investing in trust deeds. A little housekeeping before we get too far. Everybody's muted except for Brock and myself. If you have any questions, please put them in the questions section of the panel there, and we'll get to them. If we get to them either during or at the end, we'll definitely try to get to everybody's question. We are recording this, so if anybody has to drop off for any reason, we should be able to help you out from there. Anyway, let's get started. So before I get started and go too far, my lawyers tell me that Accuplan and our affiliates, we don't provide any investment advice. We are not financial advisors, tax advisors, broker-dealers. So you're supposed to do all of your research yourself and decide yourself what you want to invest in. So let's get going. A little bit about me. Here's a picture of me here, Brian Davis, Director of Business Development with Accuplan Benefit Services. My email address, briandavis@accuplan.net. And I have 3 of my websites here for you to look at, the main one being AccuplanCalifornia.com, talking about the basics of our custodial IRA accounts. Then I have a specific account, IRA with checkbookcontrol.com, that spells out how to look at a checkbook IRA. And finally, one for the solo 401k, which the site is solo401k.services. A little bit about myself. My parents are rice farmers up in Northern California. After graduating high school, I moved down to Santa Barbara, California. Went to college at UC Santa Barbara. Unfortunately, UC Santa Barbara just lost in the College World Series yesterday, but very proud that they got there. It was their first time there. It was very, very fun to watch. And then after college, I moved down here to San Diego, and I've been here for just about 15 years now. I got into doing subprime loans back then, 14, 15 years ago, and I was working for a builder division for a major brokerage company, and 2007 kind of killed us. All of a sudden, the bank realized that the subprime loans that I was help putting people into, they couldn't sell back on the market. And then the builder side of things, nobody was buying new construction. The costs were just too high at that point. So I had to go and figure out what my next step was. I got into doing life insurance and annuities and health insurance for a year or so before I realized I wanted to do something back into real estate. And as luck had it, in 2009, I got an opportunity in this world of self-directed IRAs. I was with a different IRA administrator until 2012 when Accuplan came to me and said, hey, we want you to come over and do this on our platform. And I said, this is a great opportunity. I'm an independent agent for Accuplan, and I've been with them for the last 4 years, and things are going great. And I've opened up over 1,000 to 1,500 accounts in the last 7 years doing this, and the ball just keeps rolling. It's a growing, interesting space. Accuplan is the marketing arm of our self-directed IRA custodian, which is called American Estate and Trust, which is a trust company based out of Las Vegas, Nevada, which is what allows us to be an IRA custodian. They've had their charter since 2007. But what we do is we help people open up self-directed IRAs and 401ks. We are the administrator of those accounts and help people get in, move their funds in, and get their investments done quickly. So let's jump into it. For those of you new to this space, that's okay. A lot of attorneys and accountants don't even fully understand this self-directed IRA space. Financial planners, they're not either. They specialize in securities. stocks, bonds, mutual funds. They really don't get into the alternative assets and real estate investments done inside retirement accounts. And that custodian that they're with, or if you're with on your own, most likely isn't a truly self-directed custodian, meaning they won't hold things like real estate or trust deeds inside of an IRA, which is what we do. So a little bit of things here. There's over $7 trillion in IRA assets, and this has even done a year or so ago. I think this number is closer to 7.6 trillion now, the last numbers that I saw. And the majority of those funds are in the stock market, stocks, bonds, mutual funds, ETFs, and maybe even annuities. Only about 5%, or maybe even slightly less, are in what's called an alternative asset, which is what we help people get into with their retirement accounts. Now, these numbers are growing. Brock and I, we were just talking before we started the webinar. We've been doing these webinars and live seminars since 2010 together, and my old slides here would show, oh, there's about $4 trillion in IRA assets, and only about 2% are with these self-directed IRAs. Well, what's happened since then? You know, the stock market crashed, people looking elsewhere, being able to go online and find out, hey, I can invest in something else with my retirement plan, something I might know, like real estate or a startup company that I know. And that's what we provide here. And it also didn't hurt that when Mitt Romney ran for president 4 years ago, the last cycle, it came out that he had a self-directed IRA worth north of $100 million. When all of that came out, people getting it that are into real estate, you know, why not take advantage of and invest in what you know best? So these are the main asset classes we're seeing here at Accuplan. People investing in real estate and notes and loans, which I'd say those are the top two by far. Investing in private companies. A lot of times those private companies are somehow related to real estate. And then I don't see so many of the precious metals IRAs, but we do offer them. And I don't know if that's just where I am at in Southern California or my background in real estate. I just don't see them that much, but that is also another thing we do provide. You know, your IRA can invest in almost anything. As you can see from this slide here, you can invest in tax liens, rental properties, oil and gas, lease options, promissory notes. This list can go on and on and on. IRAs kind of started back in the early 70s from a congressional act called the ERISA Act. And it outlined that you needed to have an IRA custodian, but you can invest in just about anything, but they didn't list everything you can invest in. They only listed what you couldn't invest in. And the only things that they listed were life insurance contracts and what the IRS deems as a collectible. And this is a list of some items that the IRS deems as a collectible: a work of art, a rug or antique, metals or gems, stamps or coins, an alcoholic beverage, anything illegal. And they even made a change later with allowing certain coins to be allowed inside your IRA. Now, if you've listened to other self-directed IRA presentations, you also say, what about S-Corps? IRAs can't invest in S-Corps, and that's true. That isn't in the IRA rules about being able to invest in an S-Corp. That's an S-Corp rule. S-Corps don't allow non-persons to be investors, though I do have people that loan money to S-Corps all the time. So one thing where these self-directed IRAs do get a little tricky are when your IRA gets involved in what's called a prohibited transaction. Now, this is separate from those life insurance contracts and collectibles. This is when your IRA gets involved in what's called a disqualified person. So what does that mean? Who's a disqualified person from your IRA? Well, you're a disqualified person from your IRA, and you or any of these other disqualified persons can't have any benefit from your retirement account's transaction. So besides yourself, your spouse is disqualified, and you want to think about this in a straight line up and down with family members. So parents, grandparents, kids and their spouses, grandkids and their spouses. These people are disqualified from your IRA. They can't have any personal benefit. So you can't buy a piece of rental property and rent it out to your kids, even if they're paying market rent, because the IRS sees that as a benefit to them. And you can't invest in a company in which you are the majority owner. We'll get into this more in a second. The big thing you want to point out, well, what happens if I get involved in one of these prohibited transactions? Well, as a self-directed IRA custodian, when we're reviewing transaction documents, We're just making sure that the IRA is titled correctly and that we don't see any big red flags. Like if we see a red flag like, okay, I'm buying this piece of property and the person I'm buying it from has the same last name as me as IRA, because I'd be like, okay, who is this person? You know, show us what relation they are to you. But really the onus on this is going to fall upon the IRA investor, because we're not going to see every facet of a transaction. And if your IRA does get involved in one of these prohibited transactions, the IRS can go back and disqualify your IRA as of January 1st of the year that transaction takes place. So they're not going to take the money away, they're just going to take that money away from its tax-deferred or tax-free status, which could cause a big tax hit for you. So it's something you don't want to mess with. So we'll try to play a little game. Now this works a little better live than with the webinar, but I think you'll get the gist here. Hopefully everybody remembers the game Deal or No Deal from a decade ago now on NBC. But we'll play this a little bit in regards to prohibited transactions. Now let's do this with me. Can my IRA lend myself $10,000? Is that a deal or no deal? I hope you got this one. That one is no deal. That's self-dealing right on its head. Now, what about lending to my brother? Can I lend money to my brother for $10,000? Deal or no deal? Now, if I can only get the cursor to work. There we go. That one is a deal. Now, you might not want to lend to your brother, but on the face of things, if your brother has an investment you want to invest with your brother, that is fine to do on the face of it. However, just to point out, if you're just using your brother to skirt around the rules and then your brother diverts that money back to you or another disqualified person, the IRS can come and say, hey, indirectly you broke the rule, and what they kind of put under a blanket indirect rule, they say that is not allowed. So on the face of it, if everything else with the transaction is third-party related, you can lend your brother $10,000. Now what about your stepson? Can you lend your stepson $10,000? Deal or no deal? That one is deal. If it was your son, it would be no. But stepson, the IRS says it's okay. I was doing a presentation a week or so ago, and somebody asked, why is that? The best answer I got to the question was somebody in the crowd goes, because the IRS says so. And that's really it.
I like that response.
One more here, and then we'll move forward to some more of the fun stuff. Can my IRA lend money to my daughter-in-law? Should I have one? The answer to that one, no deal. Children and their spouses. So it can get a little bit tricky, and that's what I try to be here for, to help people answer these questions. So let's move on to some of the fun stuff here. Well, how do I put money into a self-directed IRA? Well, first you open up a self-directed IRA account with us, and I'll go into the basics of that a little bit later. But then once you open it, putting money into it is just like doing it with any other IRA. So we have traditional IRAs, we have Roth IRAs, we have simple IRAs, we have SEP IRAs. How do you put money in it? Well, if you have another IRA, we'll do what's called a trustee-to-trustee transfer. And we can transfer cash and assets from that IRA over to us. And there's no tax implications for doing so. You fill out a form of ours called a transfer request form. You send it to your custodian, and they send us those funds back to us ready to invest. Well, if those funds are in an old employer plan, something like a 401k or 403b, you'll want to do what's called a direct rollover. And so you'll contact the administrator and say, Administrator, I want you to roll over those cash and or assets to my new IRA with American Estate and Trust, and they'll do so directly. Common question I get here, can I move my current company retirement plan, funds from my current company retirement plan over to a self-directed IRA? The answer to that is maybe. It depends if your plan allows for what's called an in-service rollover. If the plan allows an in-service rollover, then they might allow you to move over some of those plan assets to a plan while you're still inside of it. Otherwise, you might have to be away from the company, or the company shuts down the plan to move that over. And the third and final way to move money to an IRA is making an annual contribution. Now, most people fall in line that they have a W-2 job somewhere, and they're only allowed outside of that, their company plan to make a contribution to either a traditional or Roth IRA, which are limited to making a contribution of only $5,500 a year. If you're over 50, you can have a catch-up contribution and throw in an extra $1,000. So it's not that much that you can throw into. Most people, the bulk of their retirement plans have come from a group plan at some level, and then they've rolled those funds over to an IRA. Now, there's a couple plans here that are for the self-employed individual. One is a simple IRA, which some employers offer for small businesses. It's similar to a 401k, but the contributions limits are much smaller than a 401k, and it falls under IRA guidelines. The other one is a SEP, which stands for a self-employed pension. And this is generally for a self-employed person, and possibly their employees if they want, that allows them to contribute up to $53,000 a year. And then on top of that, we have a separate type of plan that we sell, which is a 401k plan. But it's really limited for the one-person business. That's why I put individual K here. And the IRS deems a one-person business as somebody that has their own business, whether they're sole proprietor, whether they've incorporated, what have you. That's just one person or spouses, and they don't have any other full-time W-2 employees. And there's some huge benefits that this individual K has over the SEP IRA that we'll go into in a second here. Well, first, let's keeping with the IRAs. I want to talk about the checkbook IRA. And a lot of people are using these checkbook IRAs because they want to get in transactions fast. They want to be able to go down to the courthouse, maybe go to a tax lien auction. Used to be 5 years ago when Brock and I would do these presentations, we had a lot of people doing courthouse steps here, buying properties at auction here. Not so much in Southern California right now, but in other parts of the country, this might make some sense for you. And people, investing in non-performing notes, a very popular asset class. There's a lot of touching that needs to happen with your retirement plan. So having those funds available at your fingertips in your own bank account can be quite nice. I have one of these myself. So the options out there for you are essentially the LLC or the business trust. Now the LLC has been the most common form of this checkbook IRA. We create an LLC, your IRA becomes the sole member, and you yourself become an unpaid manager of that LLC. The IRA funds the LLC, you open up a bank account for the LLC, and you can go do investing from there. If it's a single member, it's what's considered a pass-through or disregarded entity, so it doesn't have to file a federal return. However, for those folks in California, which I'm assuming most of the folks on this call are, you are going to have to deal with the Franchise Tax Board, which is going to want to charge you $800 a year just for having that LLC. And there's also a possible further tax, something called a gross receipts tax, when you have gross receipts over $250,000. I tend to prefer the other option, which is the business trust. The business trust works very similarly to this LLC model. The IRA owner becomes the IRA becomes the beneficiary owner of this business trust. The IRA owner becomes an unpaid trustee. Similarly to the LLC, if it's a one-person entity, it's a pass-through or disregarded entity, so there's no federal tax that has to be filed. But the huge benefit of it here, it doesn't have to file a state return, nor does it have to pay the Franchise Tax Board. It's $800 a year or a gross receipts tax. I have my own dedicated website to it. It's IRAwithcheckbookcontrol.com, or you can go to the retirementcheckbook.com address and it will forward you right to that spot. If anybody has questions about this, we can talk offline about the specifics of this because we could do a whole presentation just about this. So next, let's get back into opening an IRA. So you can go and open up an account with us online, and then we worry about funding the account. This is generally the longest part of the transaction is funding the account via transfer or rollover. Depending on what custodian your IRA is with, how liquid those funds are, it could take anywhere from a couple days to a couple weeks. So people really want to get your IRAs opened, and then we can help you on the funding that account. And then once we're there, we generally take about 2 business days to fund an investment. Now the solo 401k, I brought this up earlier. We call ours the 1K here at Accuplan. But what it is, it's a 401k plan for a one-person entity. So the 1K is a 401k plan for your business. And this doesn't matter if you're a sole proprietor or whether you're an LLC, C Corp, or S Corp. Now, it does make a difference how you make your contributions to those plans depending on how you're set up. But the 401k plan that we sell is what's called a self-trusted plan, meaning you're the trustee of the plan. So you can open up a bank account in the name of your 401k plan, because we get the 401k plan's own tax ID number, and you can invest directly into an investment. Some people choose to create a business trust in the middle there for anonymity's sake, and I've generally been finding that in the non-performing notes space, where people don't want other people to know that their 401k plan is the owner of their mortgage. But either way will work. Most of my clients, including myself, I have one of these solo 401k plans, and I invest directly from it myself. So it doesn't matter if you're a corporate or not. We can help with that if you want. You can roll over all of your old pre-tax retirement plan dollars into the plan and make new contributions of up to $53,000 a year. If you're over the age of 50, you can make it up to $59,000 a year. And if it's a spousal, one of these solo 401ks where it's a husband and wife type of account, they could each put in up to that $59,000. So it's a huge, huge tool. There's a lot of benefits to it. There's a Roth component to the plan, so you can have Roth funds in there, and it comes with checkbook control built in, and there's just a one-time fee to set up the account, and then you're off and running. Again, I can go into a whole other presentation about the solo 401k, but feel free to talk to me offline about that. But again, your IRA is allowed to, and individual care are allowed to invest in all these other things that you might not be seeing if you're staying in the stock market. Again, here's my information. I want to show you guys a couple other things here that we do have at Accuplan. For those that maybe buy a piece of real estate, we have online bill pay now. So you can choose to pay your bills online after you've done one using a direction of investment form. So most people, when they have an investment, they fill out one of these direction of investment forms and provide the subsequent documents. We also have now an online DOI guide, so people can just log into their account online and put in the supporting docs there and go from there. At this point, I want to make sure to hand this over to Brock. We'll answer questions at the end. If we have any time, I'll try to do some here in between, but let me see what I can do about handing this over to Brock. All right, Brock, ball's in your court. Can't hear you, Brock.
Okay, can you hear me now?
Yes.
Fantastic. So, Brian, thank you very much for that discussion. You know, a couple questions I had, though, in regards to self-directed IRAs. Now, in all disclosure, Brian Davis has set up my self-directed IRA and actually my solo 401k. And Brian's been a huge benefit for me and a lot of my clients, simply because he's there to answer questions. The self-directed IRA world, especially getting started, there's a lot of questions that need to be answered. Some of it gets a little confusing. So Brian offers really a good one-on-one service for people that are new to the business. He can help you file all the paperwork, get you started on your first investment. And I can tell you a lot of the investors that I work with and trustees work with Brian as their provider for their solo 401k. So Brian, thank you very much, and let's go ahead and get started about discussing investing in trustees. So let's go ahead and get started. My name is Brock Vandenberg. I am the president of Talimar Financial. We are a hard money lender here in San Diego. I have been doing hard money loans as a private lender for over 10 years. I started just as a small personal business investing in or financing guys that were flipping houses, and slowly over the last 10 years I've been able to create a large organization, probably one of the leading hard money lenders that are financing investors that are flipping houses. So today what I want to talk about is investing in trust deeds. Is effectively as a private lender lending money to individuals using real estate as collateral. Now before I get started, I just want to do a quick disclosure. I am a real estate broker. I'm a licensed broker. I am not an attorney and I am not an accountant. Investing in trust deeds can get complicated, and I highly suggest that you work with a good real estate attorney, especially if you're getting started in the business, to answer any questions that you have and to really minimize any pitfalls that may come up in the future while you invest in trust deeds. Trust deeds are an investment that's looked very closely at by the state of California, especially in light of the last real estate downturn. The state of California has put a lot of protections on owner-occupied residences, and if you decide to invest in trust deeds, at least on the owner-occupied side, definitely get a good attorney and understand what the rights are as a private lender in the trust deed world. What we're going to talk about is really today is a cursory overview of trust deed investments. First, I'm going to just talk basically what is a trust deed investment. What does it mean to invest in a trust deed? If you invest in a trust deed, who are you as a private lender? And then we're going to talk about why invest in trust deeds. It could be the yields that you're looking for, the consistent monthly income that you're looking for, the ability to invest locally. Maybe it's just the real estate industry that you're interested in investing in. We're going to talk about structuring a trust deed so that you can really minimize the risk to your loss of principal. At the end of the day, you're trying to invest in something that you're not going to lose money in. But then we're also going to talk about maximizing returns. So, what type of trust deeds do you want to get involved with? Who do you want to be involved with in the long term? And then we'll talk about servicing a trust deed investment. Simply, if you invest in your first trust deed, what happens there? How do you collect the money? How do you handle a borrower that may not be paying? When it comes to pay off the loan, what is your responsibility? We'll go over some of the specifics on servicing a trust deed investment. We'll also talk about locating trust deeds in your market. I highly suggest, especially if you're just getting started investing in trust deeds, look for trust deeds that are specific to your market. These trust deeds being secured on real estate, it's really nice to be able to drive by that real estate asset and make sure that's something that you want to use as collateral for your loan. 95% of the trust deeds that I'm currently invested in are located within about a 30-minute drive from my office, and that's how I like it. I like to be able to drive out, take a look at that asset, meet the borrower, and make sure it's just generally a trust deed that I want to get involved with. And then I'll leave a little time at the end for any questions or question and answers. So real quick, give you a little background about myself. I started in real estate back in 2000 as a financial analyst for a bank called Key Bank. We put together joint ventures and what's called mezzanine debt for people that are involved in flipping houses. It's really gap financing, so it's all the financing that happens after the construction loan on single-family homes. So we would joint venture, we would fund transactions with mid-sized builders, mostly through California. As the market slowed, I accepted an opportunity with the FDIC. A lot of you may have seen those videos of the FDIC going into failing banks, taking them over, and then selling those assets off to the private market. Well, I was one of those guys that went in on a Friday evening, shut the bank down, and then I managed that loan portfolio on behalf of effectively a ghost bank. It was a dead bank, and then I would sell those assets off to private investors. And then in 2009, I had a couple of my colleagues flipping houses, and they didn't have any capital to really go out and buy a large number of homes at the time. Brian, we talked about when we first got started, the big thing was to buy stuff at the courthouse steps. That was very popular at the time. Well, obviously now with the housing market so strong, that has really shifted now, and most of my borrowers are out buying homes now directly from homeowners. But that's how it really got started. I had done, I think, maybe 2 or 3 loans in 2009. Now, if I compare that to last month, where I'm doing maybe 6 or 7 loans a month, we've really been able to establish ourselves as a hard money lender for fix and flippers. So I've funded about 50 million. Actually, we're probably closer to 60 million now in hard money loans. That constitutes probably about 400 loans since 2009. Now we service an active loan portfolio of a little over 14 million. That's about 60, I think we're like 62 loans right now. So we have 14, what I call 14 million currently funded in loans, and those are all invested with outside investors. And then I manage about 100, well now it's about 140 trusted investors. So what we do is we allow outside investors to invest in our loan portfolio on an individual property basis, and then we manage that loan on behalf of the investors. And we originate about $1.5 million to $2 million a month in new loans each month. So let's jump into why I like investing in trust deeds. The biggest advantage that I see with trust deed investing is it's a fixed monthly income. There's very few investments out there that really offer fixed monthly income. You've got, and your most basic investment maybe is a savings account, which may be earning, less than 0.5% per year. For most people, that isn't a very attractive return. When you go up the scale, maybe you're invested in rental properties. Great investment long term, but for most of the investors that I work with, trusted investors, it's a very hands-on investment. They're looking for a more passive income. Collecting payments on a mortgage or on a trust deed is a much more passive investment opportunity. So, looking at the alternatives, trust deeds offer a great way of earning monthly cash flow. The other advantage is that it's secured on real estate, and to even go further than that, it's secured on real estate in your local market. So I'm here in San Diego. I like long-term, I think real estate in San Diego will always appreciate. Now, there's always going to be some downturn in the market. There'll be some economic shock that will probably occur, that will result in some home values dropping. Obviously, if you look at 2008, 2009 timeframe, we saw San Diego property values drop by as much as 30%. But I think if you look in the long term, they just simply are not building enough houses here in San Diego to supply the demand. And I think the result will be home values over the long term will continue to increase. The other advantage of trust deeds is that they offer typically about an 8 to 12% annual return. Now, back in 2009 when I first started, the returns were much higher. There was a lot less capital in the market that were funding trust deed investments. Now, as it's become more popular, again, those yields have come down. So a typical yield on a trust deed that we invest in is usually about 8 to 10%, depending upon what kind of risk you're willing to take. Now, again, if you compare that to alternative investments that offer monthly income, it's really tough to find an 8 to 10% annual return consistently in at least the California market, much less the San Diego market. Again, depending upon the types of trust deeds you invest in, they offer a low to moderate risk. Trust deeds secured at 50% of property value, I feel pretty confident that even if the trust deed were to go bad and I were required or forced to sell that property, that I'm going to be able to get my principal back. Now, as you take more, maybe a more aggressive trust deed or an investment opportunity, you may get a higher yield, but you're taking more risk. And if a market were to drop in value, you may find yourself losing principal. Typically, the trust deeds that we invest in or we're focused on investing in, typically about 50 to 65% loan to value of that real estate asset. And I feel that's a fairly safe risk that we're taking. I talk about this a lot, is the ability to invest locally. I think that's one of the most fundamental advantages of a trust deed, is that you're able to go look at the asset that you're lending on. It's very important to get comfortable with that real estate asset and make sure that it's something that, again, if the borrower stops making payments and you were forced to sell that property, that you feel that asset would sell at the value you've underwritten it to. A good example would be if someone's looking to borrow against a home that is in just complete disrepair, you're probably going to feel less comfortable with that real estate asset versus maybe a newly built home. The other advantage to investing in trust deeds is the ability to fractionalize. That means that you can have multiple investors on an individual trust deed. Now that can be an advantage and that can be a disadvantage. The advantage is that most of the trustees that we originate are about $300,000 to $400,000. And for most trust deed investors that work within my platform, that investment is just too high, and or they don't want to take all their money and invest it in a single trust deed. So they'll group themselves with other trust deed investors and purchase an interest in that trust deed. Now we manage that trust deed on behalf of all the investors, but they can own a fractional interest in that. Perfect example would be, let's say you have a $100,000 trust deed and you have $50,000 to invest. Well, you can invest in 50% of that trust deed. You become a 50% interest holder in that trust deed, and you earn 50% of the income that's generated from that trust deed. Or you earn assuming it's a 10% yield, you'll earn 10% on your money on your $50,000 portion of that trust deed. Just one thing to note, when we talk about fractionalized trust deeds, the disadvantage of a fractionalized trust deed is if that trust deed goes bad and you're forced to foreclose on the property, you're going to have to work with the other investor or investors in that trust deed to come to a resolution. And we can go into more details, ways that you can minimize the risk or the confusion that would occur in that scenario. And then the other big item about investing as a trustee is the ability to use self-directed IRA. I invest within my self-directed IRA in trust deeds, and I know a lot of my investors, I'd say probably about 30 to 40% of the capital that invest in the trust deeds that we offer are all self-directed IRAs. And so it's a great alternative investment option for your retirement funds. So let's talk about what is a trust deed investment. Trust deed investment is a very simple investment. You are simply acting as the lender and you're lending money to a borrower and using real estate as collateral. You're no different than a bank. Well, a lot of people will ask, why would a borrower go to me to borrow money and not the bank? Well, in most cases, either the borrower doesn't have very good credit, the asset that they're using as collateral has something wrong with it that the bank won't accept it, and or the borrower needs to close quickly. Those are typically the three main items of why a borrower would use a private lender to finance or to lend from, borrow from. So that's simply what a trust deed investment is. You are acting as in the capacity of a bank, lending the money to a borrower using real estate as collateral. Now, you have an agreement with that borrower that they're going to make payments to you. Most cases, it's a monthly payment. It could be 9-10% annually, paid over every month. And if that borrower stops making payments on that loan, you can force the sale of their real estate asset, and the proceeds from the sale of that asset would go to pay back your principal, your outstanding interest, any late fees and legal costs associated with that trust deed. So as you can tell, it's a pretty attractive investment. And if you do it correctly, and you leave yourself enough room on your loan, a low loan-to-value ratio, the risk to principal is pretty low. Where people start to get into trouble on these types of trust deed investments is either they're lending at too high of a loan-to-value, and so that when they sell that property, that there isn't enough proceeds from the sale of that property to repay their loan. The other issues is that they don't understand the real estate asset that they're using as collateral. We specifically focus on the residential housing market. It's what I call the most liquid type of asset, in the sense that it's kind of in the most demand of a real estate asset versus, let's say, land, which probably has the least amount of demand as a real estate asset, simply because the only value land has is what the future potential for that land. There's only a minute number or small percentage of actual buyers of land versus a buyer of a house. So let's talk about the structure of a trust deed. So as we talked about, the most basic structure is you, the bank, are lending the money to the borrower. That borrower signs a promissory note, a negotiable instrument, that records the fact that you are lending money to a borrower, and that borrower is required to make payments to you based on the schedule in the promissory note. It's required to pay you back on a certain maturity date. And then you use a trust deed, or a deed of trust, to secure your loan against the property that he owns, so that in a scenario that he stops making payments, that you can force the sale of his property, and once the property is sold, the proceeds will go back to repay your loan. Now, a couple of other common mistakes that borrowers make, or I'm sorry, trust deed investors make, is number one, they lend on what we call owner-occupied residences. The state of California, since 2008, has given a lot of rights to homeowners through a foreclosure process. The process of foreclosing on a property of which the homeowner is living in is much more difficult than what a non-owner occupied house is. And actually they've kind of made it a gray area. It's not just even if a homeowner lives in the property, it's what is the eventual use of the loan. So a borrower may have a rental property that he wants to borrow against. He may come to you as a private lender to use that as collateral. You lend the money, but you find out that that individual uses the loan for personal use. The state may actually come in and say, well, actually that was a consumer loan, and therefore he has the rights under a consumer that make it much more difficult for you to foreclose. So we talk about common mistakes. Owner occupancy loans I would suggest that you don't get involved with owner-occupied loans, but also understand your borrower and the reason that they're borrowing the money. If they're suggesting that they're going to use the money for personal use, I probably would stay away from it. If they're going to use it for business use, just have some documentation demonstrating or verifying that those funds are actually going to be used for business use. All right, like any investment, there are risks involved with trust deeds, and it's very important when investing in trust deeds is to understand those risks so that you can minimize the issues you may have on that trust deed. The number one risk factor is the loan-to-value ratio. For new investors, remember the number 65%. 65% is a very solid number or loan-to-value ratio for a loan. When I say loan-to-value ratio, that just simply is the loan amount divided by the property value. So very easily, let's say you have an asset or property that's worth $100,000. I would highly suggest that you wouldn't lend more than $65,000 on that property. That gives you enough room there that if the borrower stops making payments, that you can sell that property and get your principal, outstanding interest, and legal fees back. Additionally, when the market slows down or we have a dip in the market, you're giving yourself enough room should that value of that property drop by 10 or 20%. If it does, and the borrower stops making payments, there should still be enough spread or proceeds from the sale of that property to get your money back. And that's why you kind of want to limit it at 65% of that property value. Now, there's definitely opportunities out there to go higher loan-to-value ratio. Just understand that you're taking a greater risk on lending or using that real estate asset as collateral. What are the risk factors? The borrower ability to pay. A lot of investors go into a deal thinking they've got a great investment opportunity. The borrower is using a real estate asset, and let's say they're at 40% loan to value. So they have an asset at 100,000, they want to borrow 40,000, and so you have a 40% loan to value loan. Well, that's great, but how do you know the borrower can make the payments on the loan? You don't want to get into a loan that you know is going to fail. So one of the common mistakes that people make is not understanding how that borrower is going to make the payment. Maybe it's a rental property, right? The rental income that comes from that property may be able to cover that monthly payment for your loan. Well, that's a great, that's a great demonstration of that borrower ability to pay. But if that borrower has no cash in their bank, has demonstrated no income over a set period of time, most likely you're going to have a problem with that loan. It's a very good question to ask when investing in trustees is how does that borrower, how's that borrower going to make the monthly payment? Other risk factors, exit strategy. This is a common misunderstanding that trustee investors have in trust deeds. How do they intend to get paid back, and when am I going to get paid back? I have a lot of calls from potential borrowers that need quick cash on a property. My number one question is, well, what's the value of that property so that I can substantiate it? How are you going to make that payment every month? And then how am I going to get repaid in the long term? So most of the loans that we do are what we call fix and flip loans. So the borrower intends to sell that property once they complete the renovation. Now, I like that type of loan because, number one, there's a clear exit strategy. That borrower is trying to get out of the loan as quick as possible. All right, they're short-term loans, but there's a clear exit strategy. Number two, the asset will likely be in better condition once they're ready to sell the property than when I actually originally lent on the property. Now, if you were to go back just a decade, 10 years ago, and you were lending on an owner-occupied resident, that house is probably going to be in a worse condition 1 year from when you lent the money, and definitely 5 years from that. That house is, could have gone into disrepair. So the actual value of that asset, assuming the market didn't go up, would be less in 5 years than it is in a year. So I take the other stance that I like the fix and flip market because the borrower is clearly going to renovate the property. If I'm forced to take back or sell that property, it's most likely in a better condition than what I originally lent on it. And then the strength of the asset. Now, we don't solely focus on residential homes. That is what we discussed earlier is the most liquid type of asset. When I say liquid, that's in the most demand. If you look at any asset class, especially in San Diego, California, it's mostly homes that are being sold. Riskier assets to lend against would be, for example, let's say a commercial real estate building. There aren't as many buyers out there, and the buyers that are out there, and the sale is much more complex. So if you were to do a forced sale on a commercial real estate asset, just know that it's a much more complex process of selling that asset. Now, the extreme of that is land. If you're the biggest trouble or the biggest problems that people have when the market turns south is land. Housing market drops out, houses are not selling. Well, the value of that land drops significantly because nobody wants it. Nobody's building any homes at that time. A lot of trustee investors got caught lending on land as collateral, especially in Arizona back in 2008 and 2009. There was a lot of development going on outside of Phoenix, Scottsdale. They used land as collateral for future development, and when the housing market tanked, the value of that land became zero. Borrowers stopped making payments. Well, the lender, the trustee investor, didn't want that asset back. There was no value to it. So be careful on lending on land, and if you choose to do so, make sure you understand really what that land can be developed for. And if you're going to go on land, a good rule of thumb is keep it under 35% loan to value. Duration. I'm a big fan of shorter term loans. I like them under 12 months. The reason I like shorter term loans is that I'm not as affected by market turmoil. So if I can be in and out of a loan within 6 to 12 months, if a market starts to drop, I know that that borrower is trying to sell that asset as quick as possible. When we talk about 5-year loans, which they're great, I mean, if you can continue to get an income for a 5-year period, you're more susceptible to market risk. Say 2 years into the loan, the housing market slows substantially, and that your loan-to-value ratio drops significantly. There's nothing really you can do because you're in a 5-year loan and you're only 2 years into it. Again, it's just a preference as to if you want to go short-term, not take that market risk, or go longer-term and not be required to constantly find a new trustee after your trustee paid off. And then a risk-adjusted return. As I had mentioned, when I first started funding trustees back in 2009, I could get yields of 14 to 15% annually at 65% of future value on a fix and flip. When I say future value, when the borrower cleaned up the house, put it back on the market, my loan to value ratio is at 65%. And I could make a 14-15% return. Today, those yields have dropped significantly. Typical yield on something like that kind of loan is probably around 9 to 10%. Now, again, that's a pretty good risk-adjusted return when compared with other investment opportunities. But you can see where that return has dropped. Now, when I talk about risk-adjusted returns, if you choose to go beyond that 65% loan to value, let's say you're at 80% loan to value, make sure that you're getting paid for that risk. You should be in today's market, if that asset is in San Diego, you're probably getting paid in the 12 to 14% return range. If the loan to value ratio is closer to 50%, you're probably making 7 to 8% on your money. Now, for some people, they'd rather take a lower yield to take less risk because they know that in the long term they probably won't lose. There's no risk to their principal, or very little risk to their principal, versus that individual that may be going for a higher yield in that 13-14% range, but willing to go higher up in the loan to value ratio to 80%. Now, that latter, I would suggest to most investors, don't chase yield. When you chase yield, you'll probably lose principal in the long run. Be willing to take less yield and take the less risk opportunity. So let's talk about the primary elements of a trust deed. The first document that you have is the promissory note. And that just simply spells out the terms of the loan. The main items of a promissory note is who is the borrower, who is the lender, how much are they going to pay you annually, when are the payments due, when are the payments to be made, and that borrower signs that document. Those are the primary elements of a promissory note. We call it a negotiable instrument. So that when if that borrower stops making payments or there's some question on the loan, you've got a documentation as to what are the requirements of that borrower. You've got the deed of trust. Now, this is important. The deed of trust, a lot of people confuse the promissory note and the deed of trust. The deed of trust is actually a security instrument that you record against the property. So, say borrower A comes and requests a $50,000 loan against their property they own free and clear. There's no other liens on the property. That's worth $100,000. You're going to go ahead and record a deed of trust on that property, just like a bank would. And now you've got a secured interest in that property. So if that borrower stops making payments on that loan, you can go ahead and force the sale of the property, and the proceeds from the sale of that property go to pay back your loan and outstanding interest. Additionally, it tells all other lenders that you have a secured lien on that property, and if they choose to secure another lien on that property, they're going to be what we call in second position to you. So that when the sale of that property occurs, the proceeds will go first to you to repay your loan. Anything remaining will go to that second trustee lender. That's really important, especially in the fix and flip world. I speak with a lot of second trustee investors that may be on a deal and not understand the fact that that first position lender, that lender that recorded their deed of trust first, gets all the proceeds first from the sale of that property before they get repaid. So you can imagine how much risk there is if you're in a second position on a loan. Because if there aren't enough proceeds from the sale of the property to repay the first, you're not going to get any money back from the sale of that property. Or maybe a majority of the proceeds from the sale of the property go to the first, but there isn't enough to repay your loan, you're going to be out that money. So if you're getting involved in trust deeds for the first time, I also highly suggest invest in what we call first trust deeds. That's first position loans. You're first out when the sale of that property occurs. Additionally, the importance of the deed of trust is that when that borrower goes to pay to sell that property, if they try to transfer the ownership of that property to another owner, they can't clearly do that because they have to be able to pay off your loan first to transfer that interest. Now, obviously, there's they can transfer the interest or the ownership to anyone they want, but it really doesn't matter to you as a trust deed lender because your loan will always be recorded on that property, and that no matter what happens if they transfer that interest to another party, that you will always have an interest in that property. You won't lose that as collateral if they stop making the payment. An assignment. An assignment simply transfers the ownership of the deed of trust. So a lot of cases what we do here at Talimar Financials, we fund a lot of the transactions with our own capital, and then we make that deed of trust available to the investor. Now, when we make that available, when that investor invests in that deed of trust, we actually assign an interest in that deed of trust. We record a document that says Talimar Financial transfers its interest in that deed of trust to investor A. So that means that if Talimar Financial were to disappear, it really doesn't matter to that investor because they have a secured ownership interest in that deed of trust. Once that deed of trust, or once that loan is to be paid off, that deed of trust or that investor has to be notified and paid off from that deed of trust. Title insurance simply insures the deed of trust. When you go to record your lien on the property, you want to make sure there isn't anything what we call cloud on title, something that there's a lien on that property that may jeopardize your loan. Most cases it's property taxes, but let's say there's a judgment against the borrower, and that judgment on your let's say you have a $100,000 property and the judgment is for $100,000. Well, your recorded deed of trust on the property is worth nothing because there's already a recorded judgment against that borrower, and it's recorded on that property. Once that property sells, all the proceeds from the sale of that property would go to first pay the judgment. Anything left over would go to pay you. That's what title insurance is. It ensures that your deed of trust is, number one, recorded against the property, and there isn't anything on that property that or liens on that property that jeopardize your interest in that property. And then you've got property insurance. Obviously, you want to make sure that property insurance collateralizes or insures your collateral. That house burns down, well, there goes your collateral. So you want to make sure you have property insurance and that the borrower has added you as a lender to that policy, so that the payout of that insurance in most cases on a total destruction of your collateral would go first to you to pay you off, and then any remaining payments would go to the owner. And then you got an appraisal or BPO. Simply, it's a third party valuing the property on your behalf. BPO simply means broker price opinion. It's a scaled down appraisal. And an inspection report. So especially on single family homes and you're new to investing in trustees, you want to make sure that that property is in good condition. So we talked a little about fractionalized trust deeds. That just simply means you are investing in a trust deed with other investors. Now in the state of California, they've limited the number of trust deed investors on any trust deed to 10. And this occurred within the last 10 years simply because they had problems with trust deeds that had hundreds of investors on it. And you can imagine the issues that they had with hundreds of investors on a single trust deed. So when you do invest in trust deeds and you choose to do a fractionalized trust deed, understand how many other investors are in that trust deed and recognize there could be some risk down the road that if that trust deed goes bad and you're forced to do a foreclosure, that you'll have to work with all the other investors in that trust deed to make sure that you can get to foreclosure. A lot of cases there's a servicing agreement written up that all the trust deed investors in that loan have to sign, and it just simply spells out the rights to all the investors. Most cases, the trust deed investor that has the majority interest, so 51% or greater in that trust deed, has a final say on what occurs with that deed of trust. If there's no majority interest holder on that deed of trust, it's the combination of investors that make the majority. So just understand that. I have a lot of investors that purely just want to be single investors in the deed of trust. They've got the cash to fund a large transaction. They prefer to do that. But I have other investors that are okay investing in a fractional interest. We manage the loan on behalf of the investors, so they really look to us to make the decision as to how to proceed if we have to go to a foreclosure. So what's next? You've funded your loan. You're excited. The borrower has their funds. Now, what do you do? How do you collect payments? Now, we suggest, as a first-time trustee investor, use a third-party servicing company. The servicing company is just a middleman between you and the borrower. They send out the statement to the borrower. That borrower makes the payment to the servicing agent, and the servicing agent then makes the payments to you or all the other investors on that loan. The advantages there is that they offer statements to the borrower. They can quickly process the payments. The statements go out monthly, and then the year-end statements that go out to the borrower for tax purposes. They do all that for you, and it's relatively cheap. We use a company called FCI Lender Services. They're out of Los Angeles. To board their loan is like $45, and then every time they accept a payment and process it for you, it's like $15. It's well worth the money than you trying to create the statements every month, chase down the borrower to get the payment, and then send out the year-end tax statements at the end of the year. Additionally, we like using a loan servicer because we have a lot of fractionalized loans, and so they've got the technology to quickly calculate the distributions to every investor on that individual loan. Tips on trust deeds. I'm just wrapping up here. So number one, if you're investing in trust deeds, stick with first trust deeds. You are in as a first position trustee investor, you're in total control of that asset. If you decide to foreclose and force the sale, all those proceeds come to you first to pay you off. I work with a lot of second and third trustee investors that really didn't understand what they were getting involved with. They may be in second position behind a hard money lender who may be charging 15 or 16%, and they're having to either cover the payment every month to keep that first current, or they're trying to foreclose as well, so that they can get some type of a return on their principal. So stick with first trust deeds. Second trust deeds have a lot of risk. Thirds, just stay away from. Loan to value. Stick with 65% loan to value is a good rule of thumb. If you feel really good about that asset, you don't think the value is going to drop, you feel really good about the borrower, they've got a strong exit strategy, they can demonstrate they can make the monthly payments, you can go up to 70% loan to value, but a good rule of thumb is 65% loan to value. Again, loan to value simply is the loan amount divided by the value of the property. So the loan being $50,000, the value of the property being $100,000, you got $50,000 divided by $100,000, and that gets you 50% loan to value. Understanding the collateral. Again, understand the collateral that you're using. Homes are super easy. If the home is in good condition, you understand the value of the asset. You can look at comps pretty quick in the marketplace. If you're using commercial real estate as a collateral, get a good understanding of how commercial real estate operates and how quickly you can liquidate that asset if you need to foreclose on that property. And then, as I had mentioned earlier, stay away from land. Land values swing substantially depending upon how strong the market is. And when the market turns south, the borrower stops making payments, that value of land could go down significantly. Verify the exit strategy and timing. Like I said, I like to do short-term loans, and we like fix and flip loans. The exit strategy is pretty simple. The borrower is looking to sell the property, but let's say that borrower has a real estate asset. It's a rental property, and they need to borrow money against it. Well, they've demonstrated to you that they can make the payment from the rental income, but they haven't demonstrated how you're actually ever going to get repaid out of the loan. You may want to be repaid after 12 months or 24 months. the strategy may simply be a refinance once they can get their credit better. You know, that may be something that's okay for you if they can demonstrate that they're really trying to get, to increase their credit, and so that they can go to a traditional bank to get a lower interest rate loan to repay you. Borrower qualifications. We work with a lot of fix and flippers, so we want to understand how qualified are they to flip this home. Is it an easy paint carpet job? Okay, you don't maybe need as much experience. Are you putting a full addition on a property? We want to understand, have you done this before? If not, are you using a general contractor and an architect to do the plans for you? Because we don't want to get into this project and just see that you're completely over your head on a project. And then utilize experienced trustee brokers. So if you're first time into this marketplace and you don't have a network of borrowers that are going to borrow from you, there are people that specialize in providing trustee investments. You can simply go on to Google and do a quick search. There's plenty of them. We do offer that service to investors. So you can go onto our website and look at what trustees we currently have available and invest directly in those trustees. And then we service and manage that trustee on your behalf through FCI Lender Services, who will distribute your monthly payments to you. But if you do go through a broker, make sure they've got substantial experience. Definitely do your due diligence, call around, work, and talk to some of the other investors that may have invested through them, and make sure that they're qualified to provide you, good trustees. And then also just use your intuition when talking to a trustee broker or looking at a specific deal. Do you feel comfortable with that deal? I always call it the can I sleep at night test. At the end of the day, when I look at a trustee investment opportunity, am I going to be up all night worrying about if the borrower is going to make the payment? If I do, I'm not going to invest in it. It's just not worth my time. There's plenty of other trustee opportunities that I can get involved with. So at the end of the day, just use your intuition. If you're asking questions and something just doesn't smell right, that's probably because something isn't right. So again, just use your intuition. And then mortgage pool versus individual trustees. Mortgage pool simply is you as an investor invest in a pool of mortgages versus what we offer is individual trustees. We like to invest in individual trustees simply because you're secured directly on that asset. If that asset goes bad, you can force the foreclosure and get your proceeds back. Very different than a mortgage pool. A mortgage pool may have a couple hundred assets in it, and if the market starts to slow and they're getting there's been a lot of slow payments, there's really, you as an investor in a pool have very little power. That mortgage pool operator may have to start selling assets, but it may take a couple years for you to ever return any of your money. If you look at some of the big hard money lenders that imploded back in 2008, a lot of them used a fund structure, so investors invested in a fund, and the investors never saw any of their money back simply because that mortgage pool operator dissolved. They went into receivership, and the receiver just couldn't sell the assets quick enough or of any value to get the money back to the investor. So if I were you, I would suggest sticking with individual trustees. And so just real quick, we'll go through our typical lending criteria that we invest in. We focus on residential properties. Typical loan sizes range from $50,000 really to $350,000, though we're capable of funding up to $3 million. Typically, we stick with 50 to 70% loan-to-value ratios with rates of between 8 to 12%. I really focus on first trustees. Now, I individually will invest in second positions. Just because if I understand the first and I understand the exit strategy and feel comfortable with it, I'll do it. But I really don't get investors involved in second trust deeds. And then we just focus in California and really primarily in San Diego within a 30-minute drive of our office. So we talked about the advantages of trust deeds at the beginning of the presentation: fixed monthly income, investment secured by collateral, attractive returns, 8 to 12%, closer to 8 to 10% these days. You got low risk, 50 to 65% loan to value. Trustees are really just kind of a moderate risk investment. I don't feel that property values, if you were to foreclose on a property when the housing market slows, are going to drop by 30%. And if they do, your investment in some other asset probably is going to be affected just as badly. Your ability to fractionalize. A lot of people don't have 300 to 500,000 to invest in an individual trust deed. So with as little as 50,000, you can invest in a fractionalized ownership in a trust deed. And you can invest locally. It's important that you can be able to drive out to that real estate asset, take a look at it, get comfortable with it, and make your decision at that point. And then obviously the ability to use a self-directed IRA through Brian Davis and Accuplan is a huge advantage. When you want to take control of your retirement funds, trustee is an excellent option for that. So at this point, pretty much wrapped it up. Again, I provided just a cursory overview of investing in trust deeds. There's a lot of details that I had to just kind of run over, but if you've got any questions about trust deed investing, please ask them now, or feel free to give me a call. I have my phone number there, or my email me a question. I'd be more than happy to respond.
Well, thank you, Brock. That was a lot of information, a lot of good stuff. It's been a while since we've done one of these. I think we need to do them again. We had a lot of interest, a lot of people on the calls, and thank you all for staying on the call the whole time. I think Brock and I both went a little bit long, but so thank you guys for taking the time out of the middle of your day here. Couple questions here that I had. I answered them to the individual online. Does the solo 401k.services have a suffix like .com or .net? Well, the suffix is actually .services itself, so the website is, yes, they do. Brock, how many people will you take on a fractionalized trust deed?
So the state of California only allows me to have up to 10 investors, but most cases we limit it to about 4 investors. I'd say on average we have about 4 investors per trust deed. What you see on your screen right now is on our website. If you're to go to Talimar Financial and go over to Investor, you'll see under investors available trustees, so you can see all the available trustees that we have available, and we go into detail as to what the asset is. This is just an overview of the trust deed. If you get comfortable and want to learn more, we provide a full executive summary of that trust deed, which would include information about the borrower, more information about the real estate asset, the yield, the exit strategy, and then you as an owner in the trust deed, more information on that.
All right, well, I think that's all the questions we have right here at the moment. Oh, wait, one more. Brock, is there a minimum investment amount that you require?
Yeah, so typically we offer, I show it right here on every one of our trustees, typically the minimum investment is about $50,000. As I always suggest to investors, don't invest money that you're not in a position to lose. Now, in most cases, obviously you're not, well, not obviously, but the risk to capital, what we try to do is minimize that. But what happens in some cases on trustees is that the borrower will sometimes stop making payments, and in those cases we have to start the foreclosure process. So for investors, if they rely on that monthly income, probably is not the best investment. During the foreclosure process, it may take 4 months to foreclose on that property and force the sale. Now at that time, you may get all your outstanding interest, but you've been out of earning that interest for a 4 to 5 month period. So again, if you're relying on that monthly income, probably not the best investment for you, but if you like that opportunity, you like that monthly income, and can deal with a 4 to 5 months without the income, if that trustee goes into foreclosure, it might be a good investment for you.
All right. Well, thanks again. Unless any other last-minute questions pop up here, I want to thank everybody for taking time out of the middle of their day. If anybody needs a copy of this, it'll probably take me a few hours to get the recording up on my YouTube page and get a link. So I'll make sure Brock has it or I have it. So you can email me again at briandavis@accuplan.net. And Brock, what's your email address again?
It's bvandenberg@talimarfinancial.com, and if you look on your screen, I posted it right there.
All right. Well, I'm going to stop the recording now. Thank you, everybody, for your time. Have a great day.